Investment. The Consumer Price Index, or CPI, just dropped, and this is one of those moments that every American with a mortgage, a credit card, or a retirement account should pay attention to. The CPI is essentially the government's way of tracking how much the average person is paying for goods and services, from groceries to gas to housing. When the CPI goes up, it signals inflation is running hot, meaning your dollars aren't stretching as far as they used to. Conversely, a lower CPI can suggest that inflation is cooling, which is generally good news for your wallet. Understanding these numbers isn't just for economists. It directly affects the cost of living for every single person. Even small changes in CPI percentages can impact monthly budgets, grocery bills, and investment returns. Now, why does this matter for interest rates? The Federal Reserve monitors the CPI closely because inflation drives their policy decisions. If inflation is high, the Fed is more likely to raise interest rates to slow spending and borrowing, which in turn can cool the economy. On the flip side, if CPI indicates inflation is under control or dropping, the Fed may hold rates steady or even consider lowering them to encourage economic growth. Every time they adjust rates, it impacts everything from your mortgage payment to the interest you earn in a savings account. Understanding this connection allows you to anticipate market movements and make smarter financial decisions. Inflation doesn't just live on paper. It affects your personal finances directly. Rising prices can erode the value of your paycheck, your savings, and your investments. That's why it's critical to adjust budgets, pay off high interest debt, and even consider investments that hedge against inflation, like certain stocks, real estate, or inflation-protected securities. Even small shifts in the CPI can compound over time, affecting your long-term financial goals. Being proactive rather than reactive is the difference between watching your wealth slowly disappear and actually growing it despite the economy's ups and downs. Finally, investment. The latest CPI numbers give us a lens into the broader economic outlook. They can hint at whether consumer spending is likely to remain strong, if the job market is holding steady, and how businesses might respond in the coming months. For investors and everyday Americans alike, understanding these signals allows for smarter decisions, whether it's timing a home purchase, adjusting investment strategies, or simply knowing how far your paycheck will go. The CPI may seem like a dry number, but it is really the pulse of the economy, investment, and anyone who understands it can gain a serious advantage in planning their financial future. The Consumer Price Index, or CPI, is one of the most important indicators of the economy, yet many people overlook its real impact on daily life. Essentially, the CPI measures the average change in prices that consumers pay for a basket of goods and services over time. This includes everything from groceries and gas to rent and healthcare. When the CPI rises, it signals that prices are increasing, which means your money buys less than it did before. Conversely, when the CPI drops or grows slowly, it indicates that inflation is cooling and your purchasing power is stabilizing. For everyday Americans, this directly affects monthly expenses, from grocery bills to utility costs. Even small percentage changes can accumulate, creating significant differences in how far your paycheck stretches. Understanding the CPI helps you see beyond headlines and empowers you to make smarter budgeting, spending, and investment decisions that protect your financial well-being. The CPI doesn't just influence prices, it's a key factor in the Federal Reserve's decisions on interest rates. Investment. The Fed's main goal is to keep inflation in check while supporting economic growth, and the CPI is one of their primary gauges. When the CPI shows that inflation is rising faster than expected, the Fed often responds by raising interest rates. Higher rates make borrowing more expensive, which can slow down spending and cool inflation. On the other hand, if the CPI indicates that inflation is easing, the Fed may decide to hold rates steady or even lower them to encourage more borrowing and investment. This directly affects consumers' finances, mortgage rates, credit card interest, auto loans, and even savings account yields all move in response to Fed decisions. By understanding how CPI drives interest rate policy, individuals can better plan major purchases, investments, and debt management to protect and grow their wealth. Inflation, as reflected in the CPI, has a direct impact on personal finances, and understanding it is crucial for protecting your wealth. When prices rise, Investment. The cost of everyday essentials, groceries, gas, rent goes up, which can squeeze your budget if your income isn't keeping pace. Even modest inflation can erode the value of your savings over time, meaning that money you set aside today will buy less in the future. Investments are affected too. For example, bonds and cash holdings may lose real value, while certain assets like stocks or real estate could offer a hedge against inflation. Being proactive is key. Adjusting your budget, paying down high interest debt, and exploring investments that can outpace inflation can help preserve and grow your financial position. By staying aware of inflation trends, you can make informed decisions that minimize risk and ensure your money works harder for you rather than losing purchasing power silently over time. Investment. The latest CPI numbers are more than just statistics. They offer a snapshot of the broader economic landscape and provide insight into what we can expect in the months ahead. For policymakers, investors, and everyday Americans alike, these figures serve as an early warning system for shifts in spending, employment, and market dynamics. If the CPI shows that inflation is accelerating, it can indicate that consumer demand remains strong, but it may also signal that the cost of living is rising faster than wages. This creates pressure on households to adjust spending, investment, and it may prompt businesses to rethink pricing, hiring, and production strategies. Conversely, if CPI growth is slowing, it could suggest that the economy is stabilizing, giving the Fed more flexibility to maintain or lower interest rates, which can stimulate borrowing, investment, and consumption. For investors, these numbers can guide decisions about asset allocation. Stocks, bonds, and real estate all respond differently to inflation trends. Understanding CPI trends allows investors to position themselves in assets that are more likely to retain value or even benefit from changing conditions. On a personal level, knowing the economic signals from the CPI empowers people to plan purchases, adjust savings strategies, and manage debt more effectively. It's not just about numbers on a report. It's about interpreting what those numbers mean for the real world, your job, your investments, your household budget, and the overall trajectory of the U.S. economy. By paying attention to CPI trends, you gain a clearer picture of how the economy is evolving and how to make decisions that protect and grow your financial well-being.